7 DTECCs. $30, 7 DTECCs. I don't think it's the worst time. There's some risk. Understand that because T plus 2. If the market rallies into the end of the day, right? Like CNIS, we get a big CNIS rally and we break 3,900. That's going to put a lot of internalization pressure on GME again, and GME can break up to that $30 level, right? If GME does that, then we're going to have some T plus 2 price action. That's a lot of contracts going in the money. And so I'd be careful. You know, I sold cover calls on GME expecting the market to kind of be done rallying for the day. But it's continued to. So yeah, I mean, it could still apply more pressure. If I were going to sell more CCs right now, which I'm not, but if I were, I would be waiting till Tuesday. Waiting till the end of the day today or waiting till Tuesday. Sorry if it's repeating. No worries. Just wondering if you think this late OPEX or just market moving up. Also, does this negate Novapex? No, I don't think any of this is generating any significant amount of liquidity, right? We're not seeing any covering. If we were seeing covering, we'd have big volumetric moves and lots of price action. What I think we're seeing is us pressuring the hedge they put in place to keep OPEX from doing anything. If anything, a failure to realize price action here strengthens next OPEX. Like October looked really good, right? It looked like we saw a decent number of obligations. Internalization was picking up. We didn't really see rising costs to borrow, and that's something we'll want to look for with liquidity being bone dry right now. Is them turning to the lending pools, right? If we start to see costs to borrow just kind of inching up, obviously it's an exponential rate, so it moves up faster and faster and faster as more and more shares are borrowed. If we start to see that over the next 3 weeks, that's very bullish. Very, very bullish for November. That would be the only thing that was missing in October. And we're not getting more liquid between now and October and November, right? They'll get some ETF liquidity like next week into the beginning of the week after, and then after that there's no more liquidity, right? So if they want to get the price low before covering, they'll have to turn to the lending pools. If it's such a basic strat, why not go in depth? There's just no depth to it. I think you're looking for something that doesn't exist. Cover calls are pretty simple. You sell them, you buy them back. Risk is baked into the delta for the most part. You can skew the delta of the contract based on the implied volatility and use that to determine the safety of the call or put. But I mean, that's it. I mean, that's like as advanced as cover calls get. They're just not a complex strategy. I think you're looking to do more with them than's really there. You can use the credit from them to create spreads. You can roll them. There's just not that much to it. Like we can talk about things like the market maker hedge and how that influences it and the skew on the delta, but like no one's gonna understand that, and I'm not gonna spend 5 years trying to teach people that. Are there takeaways from the data to know where price might peak for the week of expiration? Not really. I mean, you could measure gamma exposure on the chain, but it's like it's gonna change as you approach expiration, right? No, you can't participate in the market without risk, Stefan. It's not possible. There are tips for managing stress and other emotions when trading. Yeah, I mean, you got to kind of detach yourself from what happens. Ultimately, you don't have any control, really, right? You're just making an analysis and then placing a bet, if you're trading, on that analysis. You either are confident in that analysis or you're not. I do recommend educating yourself more, honing your skills at analysis, and that will in turn build confidence, which will help reduce stress and emotion. But some people are just very prone to stress and emotion when trading, and trading is not good for them. Or they need to take on positions that are less stressful, like income positions or delta neutral positioning. Hey Greg, I hope you have an awesome weekend. I mistakenly bought 1118 27 puts, set of calls, and a rush before. Should I cut, or is there a chance for a dip end of day Monday? Thanks for being the man. Right now, there's a chance of a dip today. Looks like we're starting to see some capitulation. I mean, you're already poor, right? If you lose money, well, okay, not everyone's already poor, but some people are already poor. That's really easy. If you lose money, well, you're still poor. If you make money, then you're less poor. If you keep making money, then you'll be a lot less poor. So that's something to think about. I've been poor. I know how it is. It's tough. I still mostly live like I'm poor. If I lost everything tomorrow, I'd just make it back. I think everyone's too impatient. Like, everyone wants to get rich quick, and that's not a real thing. I mean, it happens for some lucky people, and yeah, with more market exposure, the odds of it happening to you are higher, but the amount of risk you're taking on to do it makes it not worth it, right? Because your goal is to build up money over time, not to make it all in one day. And everyone who's trying to make money in one day is going to get burned by people who have all the time in the world to make money. Like, institutions don't give a shit. They'll sit short on a position for fucking 20 years if they have to. They're not in a rush. And you guys, if you're broke and you want risk capital, like, you want to take risk and have that extra money that you can throw away, build up some money first, right? Like, a lot of you guys are selling covered calls, but you're just immediately taking that money and throwing it into risky plays. Don't do that. Just sit on that money, compound it, use it to build out more of the position that's making you money. And then when that position's making you enough money, then you can start taking risk, right? I mean, you can make 10% on your money a week selling CSPs on, like, Fubo, right? I think a little more on Upstart. And, like, GME's pretty fucking good too. And, you know, that means the next week when you sell those CSPs, you have 10% more money with which to sell them. That's a really fast rate of accumulation. If you think that, you know, a savings account is 2% a year, like, per annum, and you're making 10% a week, like, there's so many opportunities to build wealth, but people are really impatient. Do you think GME will drop into close? And yeah, kind of. I think they blew off, like, whatever internalization they needed to, and they're going to continue to try to keep the price down. Remember, this expiration is going to get rid of a lot of the call pressure, and they can push the GEX, like the market maker gamma exposure, more negative. Something that doesn't get mentioned much, but in the early SS days, it was magical to see people save money for the first time in their family. It's such a life-changing concept. I mean, it is, right? Like, everyone's like, ah, fuck, I'm only gonna make like $100 off this week, right? But, you know, that means the next week you have $100 more, and, you know, the week after that you have another $110, and so on and so forth, right? And, like, that builds up really, really fast. And, like, you guys see me risk money, and I have a decent amount of it, right? I can do that. But also, like, if my Opex play goes south and I lose 50%, I can just sell like 500 cover calls and all my money's back in my account, like nothing ever fucking happened. Right? I'm just break even. I don't give a shit if I lose money on speculative plays, because but I also worked really hard to get in a position where I could do that, and it just takes patience and time. And then, yeah, it's just another growth opportunity. You're expending risk on higher, like, you're expending capital on higher risk plays because they have a higher rate of return, knowing that, you know, you can lose all of that money, but, you know, the potential returns on that money are really, really high. But that's not all of my portfolio. You know, I have a big chunk of my portfolios in GME. I have dividend stocks. I have you know, tech stocks. I have like Google. I have commodities. You know, not only do I have like a fairly diversified portfolio, I'm selling CCs against all of that every week. You know, just look at the options OI, Stefan, and however many calls go in the money. Assume the more calls that go in the money, the more pressure there'll be on the market maker to hedge them on T+2. How much ape do you have? 0? Why would I own that piece of shit? Yeah, but I built it, right? Like, over time. It took a long time to build it. It didn't just happen overnight. Yes, I've made money on some riskier plays and options positioning, but You know, and then that money goes to safe shit. Like I did really well on CAT and SPX, right? And I'm just going to buy safe things with that. I'm just going to take those profits and buy safe things. I'm going to continue to expose the set amount of capital I have chosen to high risk plays. And then all the profits are just going into like low risk shit that I don't have to think about. So I'm using, you know, like 200 grand to generate capital for a much larger portfolio that's relatively stable. Some of it's not, but I mean, no one's perfect. It's different for every stock. There has to be a way to know. I mean, you can look at historical data on the stock and look at, you know, the effect T+2 has, and that would give you an idea of how much effect the options chain has on a stock. You can look at historic OI for that stock and see if, you know, higher OI is needed for, you know, a reaction on T+2 and so on. Enjoy the rant, but read my Ko-Fi now. It wasn't a rant. I was just talking.